Hey traders, welcome back to Sharks Academy, and in today's video I want to share with you trade management. The question you want to ask yourself is there only one way to manage your trade? Of course not. Every trader will manage their trade differently, and you should manage your trade differently from others. You have to find something that is comfortable for you, something that makes sense to you in a comfort level, right? Take for example, trader A is risking $10 per trade. Trader B over here is risking $10,000 per trade. Based off this, can you see that there will be a difference in terms of trade management, right? So for example, using the same framework as always, break of structure, pull back, shift right, we have a change of character on the 15M, and then we have this. For someone who is risking $10, it's easy to do this and hold towards the highs, okay? Because at the end of the day, when this runs towards the high, yes, this is 1:11, right, on a $10 account, and this is absolutely okay for them. But for someone who is trading $10,000 per trade, this run up, yes, $11,000, but if you take a stop loss, it's going to be $10,000. So it really depends on your risk appetite and of course your capital and whatsoever. Okay, so moving forward, how can you actually use different ways to partial, and to manage your trade? Let's give you an example. For let's say AUD CHF, okay. So previously I took a trade here. Alright, and I actually shifted my stop loss just above this area. So why did I do that? Let me just remove all of these drawings. I think it's here. Okay. Okay, now take a look at this. On the 15M, we have a change of character here. We have highs, lows, highs. We wicked out. Right, change of character. Prices came back up. I took a sell here. Okay, so when prices comes back down, this is the first area where I expected some sort of a bullish reaction, which it did. Can you see this area over here? So what is coming through this thought process? On the 5 minutes, we have a demand zone here. Okay, so what did this demand zone do? It took out high, right? So indeed we have a chop here. Can you see this change of character on the 5 minutes? So if this 1M over here, right, when this happened, if prices fails to close and break this level, then I expect this supply to get ran, right? Because the truth is that when prices taps in over here, we are expecting a lower breakdown at this level to continue the bearish movement if prices wants to go down. But what is the sign that tells you prices may want to run higher, right, to get this trendline liquidity? Is when it starts to respect demand zone like it did over here and start to change character here. Can you see? Prices tags in, change character here, respected demand zones. Based on the current framework, if this demand holds, my entry should have been taken out. And we expect supplies to get ran. And that is the thought process. And that is why you can shift your stop loss initially above here, right? This is your stop loss initially, and shift it down just above this level. This is how you actually manage your trade. And as prices again make a lower low here, right? This is a bearish move. Shift your stop loss just above this high. This is all part of trade management. And there are 1,000 ways you can do different trade management. When this happens, comes back down, shift, you get an entry over here. What do people do usually? When prices taps into this high, they take partials. Some traders take 20%, some traders take 30%, some traders take 50%, some traders just take everything. Okay? Some traders don't even take partials. Prices taps into this area. What they do is they shift their stop loss just beneath this low. Can you see? When it breaks high, they shift their stop loss just beneath this low. Why? Because their end target is over here. They want to catch the entire move for 1:5.5, for example, right? And they don't want to partials. They are okay with a relatively lower hit rate, but at higher RR. Okay, so this is just one of the ways. The second one would be to trial your stops. When prices breaks out, you have your stop loss placed here. Okay, It pulls back, it respects demand, it breaks out. They shift their stop loss here. And then this keeps happening. Okay, and eventually tap into this high. So once it taps into this high, they actually take out all of their profits. Alright, for 1:5.5 as shown previously. Otherwise, what else can they do? When prices taps into this demand on the 15, okay, this is a 15M chop for example, and then on the 1 minute time frame inside here, started to change character. So initially you have your trade entry here, stop loss beneath this low, target this high for TP1. Once this change character on the 1M, they believe that this 1M should run higher, because if it fails to do so over here, this should get red, right? So instead of taking the entire loss, they shift their stop loss just beneath this low. So the truth is that the moment 1M change character like this, they immediately shift their stop loss just beneath this low. I hope this makes sense for you. Alright, prices tags in, change character, they got involved way before that. They got involved via a 15M limit order entry. Once they shift character on the 1M, they shift their stop loss here. So when prices breaks down, they can get involved again in lower demand areas like this. So can you see the difference? When prices tags into this area, we expect a run into this high when it changes character on the lower time frame. So this 1M chop should continue running higher if it wants to into this liquidity pool. But if prices starts to distribute here, then we can expect this demand to get ran. So there is no point holding this loss. Can you see? This is going to be potential loss, paper loss, because yes, prices can indeed come back down here and go higher. So in technical terms, you shouldn't even get stopped out, right? But you cut manually because you want to enter at a better position, not sacrificing this RR over here. Can you see over here? This is, I would say, around 3 pips. All right, instead of taking the loss for 3 pips, they are actually willing to give up their entry here and get involved here again. So I mean, this is AUD CHF. Okay, so just don't mind about the pair. Imagine this as EU, right? If it's a euro dollar pair, right? Euro dollar. Okay, if this is euro dollar, then this 3 pip is significant. Why? Because euro dollar spread is almost 1 or 2 points. So 1 or 2 points simply means about 0.2, maybe. It depends on your broker ultimately, right? And the risk to reward is huge. Okay, so I hope you understand what I'm talking about, and this is just one of the ways you can manage your trades. There are many different ways. Some traders take out half when it's 1:1. All right, some traders take out around 50% when it's 1:2. So there's no right or wrong. Find something that suits you. Find something that is comfortable for you.